Good evening, everyone. Welcome to tonight's webinar. Tonight, Sensible Money's founder and CEO, Dana Anspach, will talk us through how to turn investments into a retirement paycheck. Dana is one of the nation's leading authorities on retirement planning and decumulation planning. And Sensible Money, which she founded in 2011, was last year named one of Inc. 5000's fastest growing privately owned companies in the country. She's the author of Control Your Retirement Destiny, the popular guide to decumulation planning. You can also find this as a podcast on Apple, Spotify, and iTunes. Her popular online course, How to Plan for the Perfect Retirement, is available at thegreatcourses.com and at wondrium.com. I'm Nancy Fellinger, one of the financial planners here at Sensible Money, and I'm in Pawleys Island, South Carolina. While most of the team is based in Scottsdale, Arizona, we also have team members in Massachusetts, Florida, Oregon, Indiana, and in South Dakota. We work seamlessly with each other and with clients all across the country every day using some of the same technology we're using tonight. So with that, Dana, let's get started.
All right. Now, some housekeeping items I want to go through. First of all, disclosures. So as you know, there are no guarantees in life, nor when it comes to investing. And we're going to be looking at a lot of research and case studies, and all of this is intended to be educational. I like to usually show some real life examples or historical illustrations. And one of the interesting things about retirement is so much of your results is dependent on the conditions, the year you retire, or the first 5 years of retirement. So every person's situation is different. There's nothing that we're looking at that is intended to, imply that these are guaranteed results. You could have better results, you could have worse results, all of those things that I'm sure you know, but that I must emphasize. Now, the other housekeeping item I want to cover, in case anybody's wondering, yes, I have a scab under my nose, and so I don't want anyone out there going, what, does she not know? Like, what's happening there? So I had allergies and am recovering from that, and so yes, I know it's there and everything is okay. I feel great and quite healthy. So now that housekeeping is done, let me give you an overview of what we're going to be covering tonight. I want to break this webinar into 3 key areas. First, I want to talk about logistics. How do you pull all of these various sources of cash flow together? Because we accumulate a collection of things throughout retirement. And then we get to this day where we need to live off our acorns, and we might have rental property and stock options and deferred comp plans and 401ks and IRAs and Roth IRAs and maybe mutual funds, and maybe we inherited something. And so all of these things need to now work together to create a consistent, reliable paycheck. So we're going to start with logistics. How do you coordinate all of those things? Then we're going to look at research. So when it comes to actually how you invest and deliver cash flow and look at probabilities of success, are there some strategies that might be better suited for retirement than others? So we're going to see what research has to say. The last key thing we're going to cover is behavior. So much of investing has to do with our investor behavior and our emotions. Not only our emotions, but our ability to not make emotionally driven investing decisions. And that's a key thing as you're entering retirement, because it's scary. So I don't care how much planning we've done. Every single retiree we work with, when they get to that year where they're actually retiring, they feel nervous, they feel anxious, they wonder how this is actually going to work. So that behavior is really important. So let's start with logistics. We have a collection of stuff as we near retirement. Some of the things that we see frequently are on the screen. We'll see people with real estate. I mentioned deferred comp plans, stock options. We see people with restricted stock units, with various kinds of stock grants, and then more traditional vehicles like 401ks and IRAs, 403b plans for people who worked in the education system or for hospitals. We see mutual funds that are maybe at Vanguard or Fidelity or Schwab. We see stocks. Sometimes people were gifted these, or a grandparent may have bought shares of something for them many years ago. Some things that aren't on this list, we see cash value whole life insurance policies. We see annuities. I forgot to add those to this drawing. So maybe somebody bought an annuity a few years ago, and now they're trying to figure out how does this fit into my plan. Well, the first thing that we do when we go through logistics is we lay out this cash flow plan. And it looks very much like what you're seeing here in different sections, where section A, we start with what we call non-investment income. And I made this sample very simple on purpose. Here, we have Social Security. Now, we can see one person is starting Social Security partway through the year in 2025. And then you see the benefit tier up because they get a full year of benefits in 2026. And then the other younger spouse is going to start Social Security in 2030. And so you see a partial year, a bump up there. And then you see the first year, they're both scheduled to get their full Social Security benefits would be 2031. Now, that's a lot of change in guaranteed income that occurs over that 10-year period, those first 10 years of retirement, from 27,000 of guaranteed income to 50 to 60 to 109. And from there, we just have annual inflation increases of 2% built in. Now, we're going to talk about behavior and some recency bias. That's one of behavioral finance concept that I'll cover later in the webinar. But it's interesting, a decade ago, we would use these 2% increases on Social Security, and people would say, what? Social Security is not going to increase at all. That's too high. And of course, it increased, I think, 8% in 2021. And then last year, benefits went up. I believe it was about 5.4%. And so, now people, we might use 2% and say, oh, that's too low. And so we're looking at averages over long periods of time when we do these kinds of projection models. And so we still use 2% as our baseline, which is what we've always used in our planning. So then we go to section B, where these withdrawals are supplemented, or this investment, non-investment income is supplemented with withdrawals from the portfolio. And here we see about 100,000 a year coming out of the IRA, and then we take a little bit less out each year. Out of Sally's IRA, we see about 50,000 a year, and then hers switches over to just taking out the required distributions. We also see that at the top here, you can see their beginning of year account value. So when we total it up, this sample couple has about 2.6 million in financial investment assets. And so we see later, we have some funds scheduled to come out of Sally's Roth. Now, what you don't see happening in the background are Roth IRA conversions that are scheduled to happen. And so by the time Sally got out here to take 50,000 out of her Roth, she would have substantially more in that Roth. And these scheduled withdrawals were designed so that when we add the withdrawals to the non-investment income, we were solving for a specific cash flow number that you see over here in column D. Now you'll see this number bumps up the second year of retirement, then goes down, then it's up again, and then it's significantly up out here in 2031. Well, I happen to know, and I'll show you in a minute what's going on. Those are auto purchase years. And so I'll show you, how we schedule that out. So here we have gross cash flow available for the first 20 years of retirement. Now, in reality, we think it makes sense to schedule this out throughout your projected lifetime, but to fit it all on one screen, I started with 20 years. Next, we have outgoing cash flow. Now, I pulled column D over from the previous slide, and you're going to see that these dollars match exactly column E. Well, it's not labeled E, but yeah, it is. So they're going to match exactly this total outgoing cash flow. Now, it's broken into categories: housing. This sample has a paid off mortgage, and so housing is really just property taxes and homeowners insurance. We've got living expenses, and those have an inflation factor built in. We have other expenses, and I don't know off the top of my head what that category was, but sometimes people will have discretionary expenses or gifting to children or some category that they wanted to separate out. Then here, this was vacation spending. And here we see a $20,000 a year for the first 8 years of retirement, then scheduling down to $15,000 and then 10. And this reflects a pattern of behavior that we often see that we call the go-go years, the slow-go years, and the no-go years. And during early retirement, people often travel a lot and may spend a little bit more. And so we can create a cash flow plan that reflects that behavior that we typically see with retirees. We see medical. That is a combination of expected out-of-pocket costs, health insurance, Medicare supplement policy costs, and Medicare Part B and D premiums. And so if your income's over a certain level, you will pay a higher Medicare Part B and D premium amount, and so those numbers are included. And then you see this big ticket purchase column, and that's scheduled auto purchases, and those are also inflation adjusted. You also see taxes. And so taxes are low in these first 3 years. And then as we start withdrawing from IRAs, you see this tax number gets higher. And the model we use is automatically calculating the income tax based on specifically where we took the cash flow from, and it's incorporating the taxation of Social Security and the Part B and D premiums and all of that to give us a pretty accurate projection in terms of taxes. And so here's our total outgoing cash flow. And when we take this number and we subtract out taxes and we subtract out big ticket, what I call lumpy purchases, we turn it into a monthly number that's more like what we're all used to budgeting on. And so we were solving for $11,611 a month. Now, because we're using a projection model that's software essentially, it's going to calculate everything to the dollar. And so, maybe this person really needs 11,500 or 11,600 even. You'll see this number with the big ticket item and taxes subtracted out because this is a number that needs to stay pretty consistent in retirement, right? Taxes are all over the place, and auto purchases, well, we have lumpy purchases in retirement still. We see people sometimes move or buy another property or have an adult child that gets married and they want to help pay for that, or maybe they want to gift them a down payment on a house. But for covering the regular expenses that we all need to budget for, this is that number that allows you to see logistically, like, okay, is that about what I'm used to budgeting on now, before retirement? Now, assuming we take those withdrawals that were scheduled on the previous slide out of the accounts, over here, we see our projected year-end account values. And that is assuming that the accounts average a 5% rate of return over time. That number is derived from looking at typically the worst 1/3 of historical markets, but it, of course, could be worse than that, but it gives us a starting place and a pretty conservative starting place for modeling out these potential outcomes. And so here we see they start off with about almost 2.7 million, and they're intentionally spending down their principal, but not too fast. They've left a large cushion, and they also have a paid off home, and that is not considered in this analysis. One more slide to think about in terms of logistics. Blowing up this slide where we look at just the withdrawals. Logistically, we need all of those other pieces to solve for what needs to come out of the account in which year. And here, they had about 460,000 in what we code as a non-retirement account. It might be a trust, it might be jointly titled with a husband and wife, it could be that one spouse inherited an asset and they said, yes, this asset's available for our joint cash flow. And so this pot of 460,000 for tax reasons is what was scheduled to be used first. It doesn't always work that way. Sometimes it makes sense to use IRA withdrawals first. But in this case, this pot was scheduled to be used first, And then we were going to switch over and use these IRA pots. The Roth was scheduled for big ticket items when we didn't want to pull extra money out of the IRA and potentially bump them into a higher tax rate. And then most of the Roth, because there's conversions happening in the background, are really an asset that'll likely get passed on to heirs. This is the plan that we need in order to figure out how to actually invest someone's money for retirement. Because we need this cash flow plan to say, well, if I'm going to use most of these assets first, this pot of $460,000 is probably going to be invested pretty safely. CDs and treasury bills, money market funds, now that we can earn almost 5% in a money market fund. But this Roth IRA over here, well, we don't have anything coming out of it for almost 10 years. And so we could be pretty aggressive with it and with the other Roth. And then these two IRAs, well, we need to look at them a little more carefully because we have these withdrawals scheduled to come out, but not for a few years. And so each portfolio may not be managed the same way. It may not have the same allocation because we have a specific goal now for each account type. When I talk about logistics, this is what I'm talking about. And I feel like, of course, this is what we do for a living. I don't even know how I would begin to retire without having this laid out for me, this kind of roadmap laid out. But I have had people wing it. One of the most memorable calls I ever received was someone who called me 2 weeks before they were scheduled to retire. They had been referred to us, and this was, probably I think 2006, because I remember the house I lived in. I lived in that house for 1 year, and it was in 2006. And, I answered the phone, and they said, Dana, so-and-so referred us, and we need your help. I said, okay, what's going on? They said, we're retiring. I said, well, when? And they said, in 2 weeks. And I started asking them some questions, and it was, impossible for me to help them in that time frame. They had literally waited till the last minute, and specifically what happened is they had a pension coming in, but when they went to fill out the pension paperwork, it was going to take about 90 days to process. So they literally didn't know where their next paycheck was going to come from. And I thought, oh, that is not the way I want to transition into retirement. Not all stories are like that. A lot of people do their planning either on their own or with someone, and they have a really good idea, like we've laid out here, of where their cash flow is going to come from. So once you've gotten the logistics in place and you've stress tested it and you have a pretty good idea, like, okay, this passes certain tests that tell me I'm not going to run out of money, or I have a very low probability of running out of money. And I don't even like to use that term because it's really, what's the probability that you would have to make an adjustment, that maybe you would have to lower spending by $500 a month, or not take your inflation raises. That's usually what you're solving for in these probability analysis. So once you've done this, then let's start looking at some of the research. Now, as you start to invest this pot for this cash flow goal that's laid out, what does research say? What are some of the factors that have the biggest impact on retirement income outcomes? And I use that phrase on purpose because once we're in retirement, it's no longer about maximizing the size of our portfolio. It's really around the probability that our money and our lifestyle and our cash flow lasts, that we have enough for later life expenses like long-term care, that we have enough to do all the things that we want to do. So it's a balancing act between, wow, the 55 or 65-year-old me wants to spend more now, but not so much more that I'm putting that 85-year-old me at risk. And when you look at the media and all of the different factors that try to tell us, like, what is this? Is it how much you save? Is it inflation? That's been big in the news in the last year. Is it your retirement date? Should you work longer? Is it your investment returns? Of course, the media likes to focus on what the S&P 500 is doing. Or is it your withdrawal rate? We see a lot of research around safe withdrawal rates. Well, turns out it might not be any of those things that's the biggest factor. There's a paper out written in 2019. It's called Chaos and Retirement Income, and it's one of the handouts that we uploaded that hopefully you're able to download. If not, you can search Chaos and Retirement Income by Jim Sandage on Google, and you can download it from SSRN. He talks about the single factor that his research has determined has the biggest impact on retirement success. And it turns out that it's beating the index in negative return years. Now, this isn't definitive. This is one piece of research out of many pieces of research. But when he's run the numbers all different ways, he talks about expected returns. Those aren't predictors of success. Volatility, not a predictor of success. Trying to beat a long-term average, such as the S&P, or beating an inflation rate, he calls it an irrelevant distraction that you should avoid. Yet he says beating the index in negative returns is very important. So it's the downside that becomes more predictive of success in retirement than the upside. And as an example, at the top, I've got accumulator A, we'll call them, who has a $500,000 portfolio. Year one, it goes up 20%, and they have $600,000. The next year, the markets go down 20%, and they have $480,000. Well, on the bottom side, those returns happen in the opposite order. Year one, the portfolio goes down 20%, and we have $400,000. And year two, it goes back up 20%. Well, this person wasn't retired yet, and they weren't adding or subtracting money, and so they end up with the same amount, regardless of what order those returns happened in. But now we have decumulator. This person is withdrawing money. So lucky retiree on the top, decumulator A, gets 20% returns the first year, pulls $50,000 out, portfolio goes down 20% the next year, and they have $440,000. But the unlucky retiree gets a negative return the first year, and they didn't have money set aside in a safe place, and so they have to withdraw $50,000. They now have $350,000 left. Portfolio goes up 20%, and they only have $420,000. And so those negative returns and the fact that we might have to sell some of those assets during a downturn because we need cash flow to live on, well, that's why managing that downside has such a big impact on your success on retirement income outcomes. And it's very different than how portfolio design is viewed while you're accumulating assets. So the traditional view of portfolio design looks like this. This is called an efficient frontier. And across the horizontal axis, we have risk. Across the vertical axis, we have returns. And you can see that as you start to move from a 100% bond portfolio to a 100% stock portfolio, these actual historical returns are down here. This comes from Dimensional Funds, their DFA Matrix book. It's 1985 to 2022, and the 100% stock portfolio averaged 10.86% over that time frame. And as you reduce risk, your return is lower. But if you look at the lowest one-year return, well, you had to stay invested for that whole time frame to average that 10% return, but you had to live through the 2008-2009 downturn where your portfolio would have been down 47% from peak to trough. And we can see as we get more conservative, the returns are lower, but our downside risk is lower. And this is a completely appropriate way to look at portfolio design while we're accumulating. We want to maximize returns while minimizing risk, or maybe we just want to maximize returns while we're in the accumulation phase. But when we shift to retirement, now we have annual consumption on our horizontal axis and average remaining assets at end of life really is what we're looking at on our vertical axis. And as we increase one, the other is likely to go down. So if we want to increase our annual consumption, well, then we're going to decrease the likelihood that we're going to leave a lot of wealth or have a lot left over at the end. And we have many people who come in and say, can you do that for me? Can you make it so the last check bounces? Well, we can't, because we don't know exactly how long you'll live, but we can find a balance. Now, other people really want to maximize what they're going to pass along. And in that case, they might take less cash flow out of their portfolio. We also have people who will start off feeling conservative and taking less, and then as they get perhaps 10 years into retirement and realize they're through that, what we call retirement red zone time period, that first 5 or 10 years of retirement, and that they're never going to spend all their wealth, then they will shift gears and start talking a little bit more about gifting to generations while they're here to see how those gifts are used, while they can experience, the joy of being able to help people out personally. But the key is we're solving for a different math problem in the decumulation phase. And so that's why Jim Sandage in his paper, talks about that applying these tools from the accumulation phase to the decumulation phase makes no sense. And unfortunately, the industry as a whole still looks at portfolio design and the traditional model in this risk return matrix. I was actually just in Washington, D.C. last week and got to participate in a study group of about 100 people invited from across the country to talk about this exact problem and different solutions to help bring retirement security to America. And one of those was training for financial advisors was actually one of the key topics that came up, and having financial institutions really understand that it's a different model that needs to be applied once people need to draw cash flow out in retirement. Let's look at some of the additional research, not just Jim Sandage's paper. This is a paper, I've linked to it at the bottom of the slide. It's called Equity Yield Curves, Time Segmentation, and Portfolio Optimization Strategies. I'm sure it's exactly what you've always wanted on your nightstand for bedtime reading. This was written by our investment partner, Asset Dedication. That's who we work with on portfolio design. And this paper, they talk about and compare 3 different strategies on portfolio. Strategy A, minimize the worst case. So this is where the portfolio might have a worst case decade in retirement, and the strategy seeks to make the loss as small as possible. So how do I minimize the maximum loss, if that makes sense? It's called minimax theory. So how do I make sure that my worst case scenario is as least worse as possible? Strategy B is traditional portfolio design. The technical term, maximize Sharpe ratio. It aims to build an efficient portfolio. So it's how do we deliver the highest expected return per unit of volatility. And volatility is typically measured by standard deviation, usually how much ups or downs could I experience in a single calendar year. Strategy C just simply says, hey, just maximize the portfolio for expected return. And turns out if you read their paper, that turns out to be a single asset class portfolio. And then the brown line is showing you the S&P. And so what we're seeing here is these dashed lines represent the average returns. So when they look at all these rolling time periods, 41-year rolling time periods, rolling 5-year time periods, rolling 10-year time periods, and then the whole 40 years, right? What were the average returns? Now, the solid lines represent one of the worst cases. So if we look at the worst 1 year, right? The green portfolio, strategy A, well, it wasn't as worse as the others, right? If we look at the strategy C and we wanted to maximize our expected return, well, that's fine, but we would have had a year where our portfolio was down 55%. If we were using strategy A, minimize the worst case scenario, and we got a really bad market, well, our worst case historically was down just over 30%. When we go out to 5 years, again, we see our strategy that's designed to minimize the worst case scenario was still down, but it wasn't down as much. And when we get out to 10 years, we see that our strategy that was designed to minimize the worst case scenario had a positive return, and the other strategies were still at break even or at a negative return for a full 10-year time period in the worst 10 years over this time period studied. So strategy A did a good job of minimizing the worst case scenario, but when we look at the average returns, right? Well, on average, it has lower returns all the way out until we get to 40-year time periods. So if you don't get the worst case scenario, and hopefully in retirement we don't, right? You will have possibly given up some upside in order to have a portfolio that protects you more on the downside. And so there's additional research that we'll look at that shows something very similar, right? There's trade-offs. So portfolio design will look very different depending on the goal. Strategy C, as I mentioned, if you want to maximize expected return, you'll be in a single asset class portfolio. I actually have my IRA and my Roth IRA in that strategy. There's not very many. Me and Brent Burns, one of the founders of Asset Dedication, I understand are the only two people who use that strategy, but we're very comfortable with risk, and I'll show you exactly how I plan on transitioning my portfolio to retirement, which is the same way that we suggest that clients do it. The traditional portfolio model is strategy B, and if you look within your 401k plan and they offer you model portfolios, or you look online at different asset allocation models, those are almost always designed around strategy B. And there's absolutely nothing wrong with that. I think it's very effective and while you're in the accumulation phase, and even as we'll see throughout retirement, if you plan on managing your own portfolio, it is still strategy B that is often the easiest to manage if you're doing it yourself. Strategy A is our preferred strategy, but that's because people are hiring us to do it. And so we need to be able to bring something to the table that isn't just following an asset allocation model that you can find online. And in addition, we feel like if you're hiring us, we're responsible for the results. So of course, we want to protect someone in retirement to make sure that if we get the worst case possible, that they're still going to be able to have the lifestyle and the retirement paycheck that we had laid out in the plan with minimal adjustments. So I mentioned that portfolio design can look very different depending on the goal. To show you a deeper dive, I'm just going to show you one slide from Asset Dedication that looks at S&P 500 versus commodities. So in a single one-year time frame, the worst S&P 1 year is down here, was down about 45%. And we don't see where the upside was. I don't know actually the best 1 year in the S&P. The worst 1 year for commodities was down maybe about 32%, and the best 1 year was up over 55%. So if I wanted a portfolio that was supposed to maximize returns over a shorter time period, commodities might be a better fit than the S&P. As I go out over 5 years, however, now my S&P, its worst 5 years was significantly better than commodities' worst 5 years. And my S&P's best 5 years, this top line, was significantly better than commodities' best 5 years. And so as we go all the way out, it stays that way, all the way throughout 20 years. So if I'm building a portfolio to reduce risk, and risk is measured by a unit of volatility over 1 year, my portfolio is likely to have some allocation to commodities, real estate, and certain other asset classes that have uncorrelated, they're not as highly correlated to the S&P over short time periods. But if I was building a portfolio that was optimized around longer time frames, I might say, no, commodities don't belong in that portfolio. And this research is extended across many, many different asset classes. And so for me, it helps answer a lot of the confusion that people might see in the news. So, how come this article says to do this and that article says to that? Or I talked to this financial advisor and they said to do this, and I read this blog from that one and they said to do that. Well, it could be that they're all right. They're just optimizing the portfolio or using an allocation model that has a different goal. If my goal was to maximize returns for every unit of risk, I would use a very traditional, efficient frontier type of model. If my goal was to maximize returns regardless of risk, my portfolio would look entirely different. If my goal was to maximize the worst case outcome over longer periods of time, well, my portfolio would look very different than if my goal was to reduce the worst case outcome over a short period of time. And so that is, to me, helps explain some of the confusion that we hear when we're looking at different portfolio designs and why would one person say this and one person say that. It really comes down to, I ask this question sometimes at advisor conferences. There's a presentation I do that's part of the retirement management advisor curriculum. And I'll ask advisors to raise their hand and I'll say, well, which portfolio is riskier, the yellow or the blue? Actually, I'm going to ask you guys, which portfolio is riskier? If everyone will just, we're not going to record your answers, no one else can see them, so just type in for me if you think the yellow portfolio is riskier or the blue portfolio is riskier that you're seeing on the slide right now. All right, I'm seeing a few answers come in. I see blues, I see yellows. I see yellow because inflation. I see blue, I see yellow. I love it. I love people who participate. Thank you, everybody who's out there. Anyone else want to throw a guess in there? Which portfolio is riskier, yellow or blue? I see a few more answers coming in, people that wanted to think about it. More volatility. I see that's not yellow or blue. No portfolio. All portfolios have risk. I'd like to see that answer. Thank you, everybody. So my answer is it depends on how you define risk. So if I define risk as a measure of volatility, measuring from this high peak to the low peak in the yellow, well, then the yellow portfolio is riskier, right? If that's how I measure risk, by volatility. But if I define risk as which portfolio is more likely to cause me to run out of money, right, then I would say the blue portfolio is riskier. It's not as volatile, but if this dashed white line represented the amount of money that I needed to have throughout lifetime, well, the blue portfolio might not make it, but the yellow portfolio would. But by traditional portfolio design, the yellow portfolio would be called riskier due to volatility. There is no right or wrong answer because the answer is truly, it depends on how you define risk. Now, I mentioned there's additional research that shows how different portfolio designs perform over time. This is research from Kitces and Pfau. Now, Michael Kitces presented this in person at the FPA Phoenix 2014 meeting. And I was trying to find an email with him. I am fairly sure I asked his permission to use this slide and the next slide. If I didn't, and Michael, you're out there, I'm going to ask for forgiveness after the fact. I'm hoping I'm going to represent your and Wade's research in the spirit in which it's intended. So this research isn't supposed to show that one strategy is necessarily superior to another. But what they're looking at here is a 1966 retiree, and they tested 3 different portfolio designs. So they looked at $100,000 with someone pulling out about 4% a year. Now, the yellow line labeled static said, well, if I have a portfolio that's about 60% stocks, 40% bonds, and I rebalance every year, let's see how that would have done over time. The red portfolio is an old rule of thumb you find still hanging out there on the internet sometimes that says you should take 100 minus your age, and that's how much you should have in stocks. And so as you get older, your portfolio gets more conservative. And the green line says, well, instead, what if we build, so Michael Kitces has an article called about bond tents, like camping tents. So you can Google Michael Kitces on bond tents if you'd like to read about it. So the green portfolio really says, well, what if I had a higher allocation to bonds when I started my retirement so that those CDs or bonds matured each year and I could spend that cash as it was maturing so that I didn't ever have to sell any of my stock portfolio while it was down. And that's what is represented by the green line. Now, 1966 was a horrible time to retire. If you had an allocation to stocks, they didn't do well for about 15 years, a lot of ups and downs. But the green line did the best, and it's labeled rising because over time what happened is that retiree had more equities later in retirement than what they had when they started. So it's called a rising equity glide path. And they have a paper on it called Rising Equity Glide Path that you can Google and find by Kitces and Pfau. And so over this particular time period, right, that green strategy held up better. Your portfolio was maintained, whereas the other two became depleted in the last 10 years of retirement. However, over a 1982 retiree, one of the best historical times you could have retired, it turns out the green portfolio was the worst. And the yellow, very traditional, 60-40 rebalance every year portfolio did the best. And so again, this reflects the trade-offs, right? If you want to maximize average returns, that's really what that yellow line does. But there are other portfolio strategies that may hold up better in a worst case scenario. Wade Pfau, one of the researchers, went on and did additional research. This is from an article of his in 2017 on time segmentation. And he studied these different portfolio strategies. So this dashed line here called 60.8, 39.2, it's basically 60% stocks, 40% bonds. And so he explains why he used 60.8 and 39.2 in the full article. But it's saying, okay, that very traditional 60% stocks, 40% bonds, and I rebalance every year and take out what I need. Well, here's my retirement duration across the horizontal axis and my probability of success, right? And so the longer I spend in retirement, the lower my probability of success, but that portfolio had a pretty good probability of success. Then we have the next one called automatic rolling ladder. What does that mean, right? So that's this gray bar down here, which says, well, I start off with that bond ladder, what I was referring to like the bond tent, and I might have 10 years, and actually he said he used a 10-year bond ladder. So let's say I need $60,000 a year, and I'm going to show you an example of this in a minute. So by the time I get to retirement, every year I have a CD or a bond maturing worth $60,000, and that's going to fund my cash flow, the $5,000 a month that I need from that. And automatic means as I spend the first bond that matured, I would sell some of my equity portfolio in year 1 and buy another bond that matures in year 10. And so it just happens automatically. I'm going to ignore these matching total returns line are basically, whether you sell the stocks and buy the bonds or whether you do it through kind of a traditional rebalancing program. He was basically testing the two. And if you want to know the technical details, you can go read the article. The green market-based said basically, well, okay, instead of just automatically selling stocks and buying bonds, what if I only sell stocks after a positive year in the market? And then I replenish my bond bucket that I used up for consumption. And personalized rolling ladders, this yellow line says, well, what if I measure when to sell stocks and refill my bond bucket by a personalized approach to what I need throughout my life, rather than based on what the market is doing. This yellow line strategy is what we do in our firm. We use something called a critical path that I'm going to show you. And this matching total returns, what Wade was trying to do by adding it was saying, well, was it specifically the bond ladder that caused this to be the highest probability of success? Or was it the fact that, you were rebalancing to that allocation, but the allocation happened to change, right? Rather than 60-40, one year it could be 45-55, or it could be 65-35. It wasn't rebalancing to a specific allocation. It was rebalancing to the cash flows that were needed in the plan. Those dashed lines simply mean that, well, it came from the allocation decision. There wasn't anything magic about using, the individual bonds. But the individual bonds make it easy to know I need $60,000 of cash flow. Great, I have a $60,000 bond maturing. So again, we have research that shows that certain strategies improve your probability of success. And so none of what I'm showing is intended to say this strategy is superior. It's really intended to educate you on there are different strategies and different trade-offs. And so one of the important decisions you'll make is, well, what strategy do I want to use during my retirement years? So I want to show you what this personalized rolling ladder looks like. When you say personalized rolling ladder, this is what asset dedication calls a critical path. These dashed white lines might represent your savings years, where you're, accumulating as much as possible, and then you retire. And that asset path starts to flatten out, and this decline here isn't a foregone conclusion. It's saying, what's the minimum amount that I would need to have to bounce the last check? So the expectation is that the portfolio wouldn't just decline like this, but it's really solving for, let's say I needed, $100,000 in year 50. Well, the year before, I better have $100,000 left in my portfolio if the last check's going to bounce. So that's what this is solving for. Over time, you measure against this. So this is a sample of saying, well, if this is what someone's critical path looked like when they retired in 2015, and then this was their actual portfolio. So what does a personalized rolling ladder look like? Well, during these years where the portfolio was below the dashed white line, you would say, well, I'm not going to sell any stocks to replenish the bonds that I used. But during these years, you would sell and you would refill your bond bucket. During this downturn, this was March 2020, what I call flash bear market of COVID, you wouldn't be selling any stocks. But during these years after, you would be selling stocks to replenish. And it would be measured not by necessarily the market, but by, are you ahead of your own personal critical path? So if we go back to this research, that's the difference between a market-based ladder, where you're making the decision based on whether the market was up or down, or a personalized ladder, where you're making the decision based on where you are relative to your personalized critical path, which comes out of doing all of the logistics first. So that's what that strategy looks like. All the research that I've seen, including what Wade Pfau and Michael Kitces talk about, says there's nothing magic about the portfolio strategy itself, but behaviorally, it has a lot of benefits, and we're going to be talking about behavior in a minute. So we all do something called mental accounting, and some of us have very specific, like we might have a savings account for Christmas versus, our property taxes versus, a clothing fund. I've seen people with up to 15 different savings accounts for specific purposes. And so, but the mental accounting part of retirement says, wow, I feel better knowing this bond or CD is going to mature, and that's what's going to cover my withdrawals. And if the stock market's down 25% that year, I don't have to worry, and I don't have to sell any of that during that time period. It doesn't eliminate risk, so it helps, as I call it, manage some of the risks that we're exposed to. So if you're a retiree and your first 5 years in the markets are really one of the worst 5 years ever, you're still going to have less wealth in retirement than someone who retired in the first 5 years were the best market years ever, right? So you can't eliminate that risk, but you can help make sure you don't compound that risk by making poor decisions. So I mentioned I would share with you a more specific example, and I am going to use me as an example. So I am 52 this year, and I think it's very likely I will work till 70 because I'm lucky that I love what I do and I am the owner of the business. I did sell 10% to 2 new partners last year, but I am still very much the majority owner. But you never know, health, other things could happen. And so if I want to have a just in case plan to start at 65, what would I do? Well, right now I'm 100% equity. That's how I keep all of my retirement portfolio. You know, for me, I understand the risks. I could care less if it's down 45% in a single year. I'm not going to start worrying about it till I'm actually closer. When I get to be 55 is when I would start building out my bond ladder. And my goal, let's say I need 60,000 a year from my portfolio. My goal would be to say, okay, by the time I got to 65, if I thought that was the earliest I might retire, how do I have this predictable cash flow bucket filled? Well, here's what that would look like. And I believe this started off with a sample $1 million portfolio. Now in this sample, I used someone age 56. So this is probably when I would start. My portfolio transition would be around age 55 or 56. And these are hypothetical numbers with portfolio returns that are up some years and negative some years and up some years and negative some years. And so year one, and here I used a market-based strategy and said, well, if the equities had a positive return, I'm going to sell 60,000 and I'm going to add 60,000 to my bond ladder. And I'm contributing, assume I'm still working, 25,000 a year to the 401k. I'm actually maximizing mine, but in the sample, this was someone contributing 25,000 a year. And that 25,000 is going into the equity bucket. So year two, the equities had a positive return. You sell 60,000, you buy a bond that matures. And when I say this first bond would mature out here when I turn 66, this bond that I would buy was going to mature 10 years later when I turn 67. Next year, bear market, don't do anything. Following year, up market. Once again, I start to extend and sell stocks and buy bonds. Next year, pretty strong market. So I sell 2 years worth of stocks and buy 2 years worth of bonds. And I keep this process going. And by the time I get to 65, if you add these up, I now have 10 years worth of bonds maturing at $60,000 each. So I have now filled up my predictable cash flow bucket, actually all the way to the top. This glass isn't quite full. And so then what happens? Now, let's assume I'm 65. And when I see a question that just came in, it says, when you say buy bonds, do you mean individual bonds or bond funds? In this sample, I'm saying individual bonds. So same as what the research was showing for Wade Pfau when we're talking about rolling bond ladders. It's individual bonds that are maturing, where they're treasury bills or agency bonds or CDs, where you actually know what you're getting, right? You know exactly the dollar amount that you're getting and when you're getting it. Then in retirement, what does that look like? Well, each year you see this $60,000 bond that matures, and I have 10 years worth of these ready to go. So let's say my first year of retirement, the market's down 67%, or not down, I'm 66, the market's down 17% that year. Well, I don't do anything, my bond matures, and I have my $60,000 that I'm going to direct deposit to myself $5,000 a month, because that's how we're used to budgeting. So that's how I recommend people, take things out in terms of a monthly retirement paycheck. It helps you manage your spending the same way that you do when you're working. The following year, market has a good year, so I would sell $60,000 of stocks, but I would be buying a bond that matures out here 10 years later. So I can get typically maybe not right now today, but normally you get higher yields on longer bonds rather than shorter term bonds. And so this strategy would allow you to get those higher yields by buying that bond that matures out 10 years. And so this process would keep going. And over here, you see based on these average returns, and I think this was run on a pretty conservative, like a 4% or 4.5% average portfolio return. But as you know, portfolios don't ever earn the average in any given year. It goes up and down like we're seeing here. And so here you see the portfolio balance as it's going. So you started retirement with 1.8, and now you're about a decade into retirement with about 1.7. That type of strategy, if you look at the asset allocation, these pie charts say, well, year one, you're 95% stocks, 5% bonds. Year two, you're 90-10. Year three, it ends up, that was the year we didn't make any decisions. The market was down. It ends up 88-12. And so you can see that progression until right about retirement. It ends up being about 63-37, about 60-40. And then it changes based on when you're deciding to kind of refill that paycheck bucket, that paycheck or bond side of your portfolio. When you look at the research that is talking about the personalized ladder, so I'm going to go back to this slide. That is, what I just showed you in that slide was more of a market-based ladder because it's hypothetical, so I can't tell you, that specific critical path. But doing a strategy like that, but based on your personal critical path, is what this personalized rolling ladder is what Wade was trying to illustrate in that research. Now, my view in retirement is that I would prefer to build a portfolio to minimize the worst case scenario. That is, the approach that we prefer. It doesn't mean it will perform better over time, but if we get a worst case scenario, I'm going to feel a heck of a lot better, right? I lived through 2008 and 2009. I had clients that retired in December 2006 and 2007. So I know how scary that is for them and for us as advisors. It's not fun for us either, right? Getting people to stick with their program and stick with the strategy is super, super important during those times. And so having studied a lot of that and studied the 1966 and early 1970s time period, for me, retirement was always about minimizing that worst case scenario. But Wade does conclude in his research that for most people who are going to do it themselves, that total return strategy is a strong contender. And that's this one right here. And under most scenarios, it's going to do great and hold up just fine. And so I think one of the key decision you need to make outside of when you're going to retire is looking at, I use these vehicles, what strategy are you going to use, right? Do you want the race car? That's maximizing average returns. I'm completely comfortable with that right now when I'm still far away from retirement. Do you want a total return strategy based on efficiency, meaning how do I maximize returns for a given level of risk? And I think of that like a good solid 4-door economy car. It gives good gas mileage, it's going to get you over most terrain, it's comfortable, right? That car is going to be absolutely just fine under most conditions. Or do you want the off-road all-terrain vehicle, right? Do you want a portfolio that says, well, if conditions get rough, this is a portfolio that's going to get me through a little bit better than either of the others? And there isn't a right or wrong decision, but it is key to understand what you're doing, or if you're working with an advisor, what they're doing, what strategy are they using? And there's going to be a rationale behind it, right? If there's not, then you're in trouble. So you want to know, if you're doing it yourself, what's your rationale? If you're working with someone, what is their rationale? And you want it to be a rationale and an approach that you align with. So the last thing I'm going to talk about, and then we are going to open it up for Q&A, is behavior. Now, this is one of my favorite cartoons. Financial reporting, just, oh my gosh, the headlines are crazy, right? It's like a sports game. It's like live betting. And when things get turbulent, we do often tell people, like, just turn off the news. It's distracting, it's not helping, and we shouldn't be making daily moves in your portfolio based on what's in the headlines. Well, one of my favorite books on behavior is The Psychology of Money by Morgan Housel. And I loved this quote he has, that doing well with money has little to do with how smart you are and a lot to do with how you behave. And behavior is hard to teach even to really smart people. Isn't that the truth? Think about how much trouble we have eating healthy or exercising regularly or doing all kinds of things that we know are good for us. And then when it comes to money, we can be so emotional. Warren Buffett says if you cannot control your emotions, you cannot control your money. And that I 100% agree with. There is a true behavioral bias. So behavioral finance is a field of study, and they have quantified various behavioral biases is the term and given them names. Emotional gap is one of the names, and that's when we make irrational decisions based on strong emotions like anxiety or anger or fear or excitement. And so that can be a key reason why we don't make rational decisions. There is also a behavioral bias called recency bias. And I talked about that when I was talking about Social Security and the inflation adjustments we use, and how years ago people said, what, Social Security is not going to go up at all. And now it's like, what? You're not using a high enough inflation rate. Well, we all have that recency bias as if what's happening in recent times is the way it's always going to be. I mentioned that, I have people who retired in December 2006, 2007. One of my favorite slides I like to use to illustrate behavioral things is, can you see the forest for the trees? So imagine you'd retired in December 2007. This is your first year into retirement. And in the 7 months from September 08 to March 9th, the S&P was down 46%. Even a well-balanced portfolio, 60% stocks, 40% bonds, was down between 30 and 35% that year. Scary. And it was scary because I was there and I had people who just retired. Now, if we zoom out and we go, well, let's say you just didn't react and you let your portfolio do what it's going to do. Well, here's what that looked like in the rear view mirror. So even if you invested right here at this black dot before the decline, your 5.5-year return was still 7.6%. That's gross return, gross of fees and taxes. When I say behaviorally, as advisors at that time, we did everything we could to keep people sticking with their plan. But invariably, there's a few, and if someone calls and says, I can't take it anymore, put everything in cash. We don't have a choice. And we had a few clients who did go to cash, and it was almost all, 2 of them on, I believe it was March 8th or March 9th. And that's that behavioral piece that, can cause more damage than anything else. Now, eventually they got back in, but if they waited to get back in, they missed all of this upside. And so they turned what would have been a temporary loss in their portfolio that it was designed to withstand into a permanent loss because of behavior, not because of what the market or the investment did, but because of how they reacted to it. And so behavior becomes a key to understanding, how will you react in retirement? How do you react now? And it can get scarier in retirement. The last behavioral piece I want to touch on before we open it up to Q&A is research by Michael Finke. This was a report, and it's also on SSRN. It is issued in May of 2020. It's on financial literacy as we age. Now, another common behavioral bias that's documented is called overconfidence. So, for example, in a study of US drivers, 93% of us say that our driving skills are above average. Well, that can't be true. that particular statistic, they've actually studied across all different countries, and routinely, a large majority of people all think they're above average drivers. It so happens in the US, we are even more overconfident about our driving skills relative to other countries. Imagine that. But of course, 93% of us can't have, above average driving skills. So overconfidence comes from thinking that something that seems obvious or something we just know something's going to happen. There's also something called hindsight bias, which means in the rearview mirror, it seems obvious. I should have done this. I should have done that, but it wasn't obvious at the time. And these, again, are documented, human biases that we all have. Well, when they look at aging, they looked at confidence. So confidence in our financial decisions tends to go up by almost 10% from age 60 to mid 70s. However, when they gave people financial literacy tests, they did more poorly on those tests, and that decline continued throughout the aging process. And so to me, this is scary. So we get more confident about the decisions we're making, but our actual ability to make the decisions as rationally is declining. So it's the worst combination to me, is to say, oh my gosh, so we're going to get more confident and yet not be able to evaluate things as effectively. So I think it's something to be aware of. Many people will have a spouse, if you're part of a couple, that is the primary financial person. Is your other half willing and able to take over that role, or do you need to have someone in place for them? And as you age, are you going to stay in that role, or are you going to need to engage someone, whether it be a professional or a trusted family member that assists? So those are all things to think about. Wow, that was a lot. So with that, as we usually do, we're going to open it up for Q&A. Nancy's going to come back and help me with that. Now, one of the things I've got up here on the slide, I do want to let you know our next webinar is going to be Thursday. We're going to skip the summer, but Thursday, September 28th, it's going to be on planning for healthcare costs, and I am inviting some health insurance experts along. So we're going to be talking about retiring pre-65, healthcare in that phase, then the transition to Medicare, and then long-term care costs later in life.
All right, there are several questions here already, Dana. The first one would be, do you run lifetime projections to try and minimize taxes throughout the lifetime of the plan?
Yes, we do. And so that is typically the objective. So it kind of differentiating the way a CPA or a tax preparer often looks at taxes is, well, if you put this money, in an IRA, you can save X amount on your taxes this year. Well, we look at it a little differently and say, well, but yeah, then you're going to have to take required minimum distributions later, and that could make more of your Part B premiums tax, or bump you into a higher Part B premium threshold. And so all of these factors work together. And it turns out that the decision that saves you the most taxes today isn't always the decision that reduces your tax bill over your lifetime. So we believe in looking at things over your lifetime and saying what decisions are most likely to minimize your taxes over your lifetime.
And this questioner had a follow-up question. So it looks like this goes back to when you were first starting to go through the spreadsheets, and so the question is, it looked like in the spreadsheet withdrawals followed brokerage, traditional, and Roth last. Does your analysis determine what money types to withdraw from each year to minimize taxes over your lifetime? And do you use a program like Income Solver to make those decisions, or regular planning software?
Yes, we do determine which to withdraw from. And so it's not always in that order. That happened to be the order of withdrawal for that particular sample. But we've seen cases, as I mentioned, where you should withdraw from the IRAs first. It is almost always the case that Roth's withdrawals are last. So I will qualify that. That's pretty consistent. We use our own model that we built. And so no, we don't use Income Solver, nor do we use regular planning software. We use our own model because we know exactly what's happening in the black box. And when some of our clients who are very detailed and specific want to know exactly where that number came from, it makes it very easy for us to find it and answer some really granular questions.
How do SPIAs work with this bond withdrawal strategy you're presenting?
So SPIAs are part of, we didn't, show that part of the planning model. So I was just looking at cash flows from a traditional portfolio. But when you're going through the logistics part in section 1, you can look at how much guaranteed income do you have relative to your total spending, and we call that a coverage ratio. And so then you can say, all right, well, if I took some money out of my traditional portfolio and plugged it into either a SPIA, which is a single premium immediate annuity, if I want to cash flow today, or a deferred income annuity, where you might say, well, I'm going to put this money over here into this annuity product today, and it's going to guarantee me cash flow starting in 10 years. We actually can see if that improves the portfolio metrics. So we use something called fundedness, much like the calculation a pension plan would use to see if it's sufficiently funded to deliver its cash flows. And so in many cases, adding annuities, of course, Wade's research shows this, improves the outcomes. So it can improve your, what we call retirement security. You have more guaranteed income, and it can actually improve the assets you have at the end of the plan. Because assuming you do live a long, healthy life, you have that guaranteed income coming from the annuity now, and so the rest of your assets stay invested and can actually be invested a little more aggressively. So that all gets fit into the planning process actually before you even get to the kind of portfolio strategies that we talked about here.
So going back to the modeling of how you build an income ladder, the question is, so you're looking at whether the market went up in the prior year. This is the 60,000, and then skip a year and then make up for it down the road, versus what Wade suggests is looking to see if your portfolio is more than what it was when you retired.
So in that sample, yes, right? So I didn't run out the whole personalized critical path for that sample. So I was just using that as an example of, like, logistically, when we talk about bond ladders, people are like, I don't understand what you mean and how would this work? And so yes, we would recommend that personalized approach where you're doing it relative to your assets. Now, it's not just having more than what you had at your retired. That personalized approach is actually projecting all your income and all your spending over your lifetime and creating a personal glide path, a personal trajectory, not even a glide path, because glide path refers to your allocation. So it's a personalized trajectory. It's not just, do I have more assets than what I had at retirement? But no, that is not what I was doing in the sample. You are correct. I was just trying to logistically use that to show now what that would look like. Now, in reality, most of the time when you're ahead of your path, it is because the markets have performed well, but not all the time. The market could have a mediocre year and you could still be ahead of what your critical path number is, and you would still want to sell stocks and buy bonds. And so that was a great question that you're asking.
When financial advisors say clients use or dip into their principal, how is the principal defined exactly? Is it the value of the portfolio on the date of retirement, or is it the sum of all the contributions to 401k, IRA, taxable accounts over the years?
Usually principal is defined as the value of your portfolio. And so when people talk about like dipping into principal, I don't hear this as much now, but even a decade ago, people used to want to live off just the interest and the dividends. And so you would own stocks, dividend paying stocks or CDs, and if you might think about some of you out there, your parents, may have CDs and they just wanted to live off the interest from those CDs. So that kind of language really comes from that time period where people thought of just living off the dividend and interest income of their portfolio.
So along those lines, what about using dividends, capital gains, money market, Social Security, and annuities for your paycheck? The dividends, capital gains, and money market would need to provide about 8,000 of a 10,000 amount needed monthly. So that's one part of the question, Dana. And then how much money should be in a money market to be safe during a down market Would the dividends and capital gains be enough of a paycheck?
So,
Depends.
that's exactly the strategy we were just talking about, right? Where people are like, well, I'm just going to live off the investment income. Well, capital gains can vary tremendously from year to year. And dividends in 2008, many companies stopped or severely cut their dividends. And so if you're going to do that, you have to be prepared for a variable paycheck. And so in normal years, it's probably going to stay pretty steady, but in down years, your paycheck can go down. And so my thought is most people want a more consistent paycheck in retirement. And so you can design the portfolio so that regardless of how the dividends change, you have a very consistent paycheck. If someone needs $5,000 a month, and yes, Social Security and all those things can be incorporated in that, then by golly, they need $5,000 a month. We don't want a year where, sorry, this year it's only going to be $4,000 a month because these companies cut their dividends. And so I think that's the answer. I remember, doing a plan for a very high net worth individual. He managed his own portfolio. It was around that 8 to 9 million mark. And we had this whole conversation. And ultimately, that's the strategy that he was comfortable with. But he had the assets, and so much income that it didn't really matter if his paycheck fluctuated a lot from year to year. And so he was just fine with that. The other thing is, who are you leaving this money for? And that may not be a concern. Like some people are like, oh my gosh, they're going to pass along. I think, what's the story of the lady in New York who passed along like $8 million? She was like a librarian or something, and no one knew she had this money. I was just reading this again the other day. That's fine, and it was a really cool story, but a lot of times there's that balance of, wow, I could be gifting to these people that are eventually going to get my money, someone's going to get it along the way if I used a different approach. And so I think that's there's absolutely nothing wrong with living off the interest and dividends. You may end up with a bigger pot of money at the end of retirement than what you had at the beginning of retirement. And if that's your desired approach, then I think it works just fine.
For my near-term, in quotes, cash bucket, what are the pros and cons of using a money market fund versus a 1 or 2 year CD? They're all paying nearly 5%.
Well, the money market is more liquid. So, we custody at Schwab. Schwab's money market, last I looked, was paying 4.9%, and you can sell it in a day with no penalties, right? So, very, very liquid. Whereas the CD, if you're going to tie your money up for a year, you're going to have to wait until it matures. The money market, the interest rate will adjust very rapidly as the Fed adjusts the Fed funds rate. So if the Fed raises another quarter point, typically within about 4 to 6 weeks, money markets own a lot of short-term treasury bills. So in about 4 to 6 weeks, you typically see the yield on that money market go up by about a quarter a point each time the Fed raises rates. On the flip side, if the Fed lowers rates, you will see that yield go down, within 4 to 6 weeks of each rate change. And so if you think that we're going to see additional interest rate increases, the money market's going to allow you to participate in those versus the CD is going to lock in the outcome for a year. If you go, oh, we could see lower interest rates a year from now, maybe you want to lock in that CD rate. So to me, the biggest factor is liquidity, right? Do you want access to your money? That's a moment's notice. That should be your primary factor. If the answer is yes, money market. The second factor is then, do you want that rate to adjust as the Fed changes rates, or do you want to lock it in? If you want to lock it in, then a CD is the right choice.
I've heard mixed feedback on use of QLACs for longevity insurance. What's your perspective? Seems like you prefer bond ladders.
I do prefer bond ladders. It's probably my own bias, right? So as financial advisors, we have biases too. And some of it's related to taxes, and it depends. Like if you're single, I think a QLAC is a different question than if you're married. So when you look at married tax filers and then getting a lot of guaranteed income later in life, when someone might potentially have changed to a single tax filer, I've always been concerned that the QLAC would cause this kind of delayed tax event around age 85. However, I have a client who just brought me a strategy. So they want to do a QLAC, And now the limits, the amount you can put into it, for those who don't know what it is, I'm sorry, I'm using these acronyms. It's a qualified longevity annuity contract. You're allowed to buy, I can't remember how much now, within a 401k or IRA. And it's basically a deferred income annuity. So it doesn't start paying you out until you're age 85. And so if you wanted to be assured that you could spend more of your portfolio between now and age 85, it would give you this safety net, right? Of saying, well, at 85, I know I have X amount of guaranteed income coming in. And so that's what a QLAC is. And they changed with the Secure Act 2.0 the amount that you could put into them. It was capped at 125,000, and I just can't remember what it is now. So I have a client that came and said, well, you know what? I think I'd like to do this, but we really want to gift to charity. We realize we're never going to spend our wealth. They're not, they're very, as we call it, overfunded. If we'll name a charity probably as a beneficiary of it, but that way it's there if we need it. So if for some reason we would need it at 85, we'll turn it on and take it. But if one of us is a single surviving spouse and it's going to cause tax problems, we're just going to make the charity the beneficiary of this income. I thought that was pretty cool. I was like, I'm going to put this strategy down for some of our other clients. I like bond ladders because of what's called optionality. So if you look at Wade Pfau's new RISA, the Retirement Income Style Awareness Questionnaire, he kind of categorizes people, and some of the things you consider was safety first, or do you want more flexibility? Do you want optionality, or do you want a more committed strategy? And so I like the optionality, especially early in retirement. So much changes. We've seen people get health issues, or they decide to move, they want to be closer to grandkids. It's, it's not just we retire and something stays static. And so that's probably why I'm a little biased toward bond ladders, but we help people implement whatever strategy is right for them. So ultimately, we try to recognize if we have biases and then kind of acknowledge that, and then come to the table and say quantitatively, if I plug this QLAC into your plan, does it improve your outcome? And if the answer is yes, I'm ultimately a math person, and I'll say, great, look, it increased your fundedness and it did this and it did that and allowed you to spend more along the way, then let's do it.
And QLACs are 200,000. I had to look it up, and one of our attendees also pointed that out.
Oh,
200,000.
Thank
you. The question that always gets asked in these is, could you please share an update about when you're writing your next book? Also, what topic will you be covering at Boggleheads Conference this year?
Oh, well, the book question first. I don't know. It's such a big time commitment. And so we're trying to do some hiring. Those of you who probably heard this answer before here at the firm, and reduce my workload. But until that happens, our clients come first and our staff comes first. And so I just, can't dedicate time to the writing until we have, more of the daily responsibilities at the firm covered. And so on the Boggleheads conference, I don't know what the topic is yet. So they will do a speaker call and go over, what they want us to present on. So I don't know yet what that topic's going to be, but I can tell you it is an incredible honor to be invited to speak there. So I started writing online in about 2007, and it was always groups from the Bogleheads that would offer me corrections to my content. Sometimes it was just typos, or they were just wonderful at asking questions and sending resources to me, and everybody I encountered was always so polite. When you write online, sometimes people are mean, and we didn't have editors. We had to edit our own stuff, and it's hard, right? And so sometimes you do have a typo, and some people are nasty. And so, but they were always so polite and wonderful, and I just really appreciated it. So it's an honor to be invited there.
What year did you create the Perfect Retirement course for thegreatcourses.com, and do you deem the material still relevant today with all the changes in retirement laws and taxes?
I had to fly out to Virginia during the pandemic. Yeah, so it would have been the tail end of 2020 that course was created. I think it was released January 2021. Gosh, I just remember it so clearly because I had to fly through the Atlanta airport in like September of 2020, and it was empty. empty. And it was the most eerie thing I've ever experienced. I think in my whole life, it was just, honestly, it was so eerie. Anyway, that's not what you were asking. So yes, I still consider it to be very relevant. There's not a whole lot. I mean, the Secure Act 2.0 changed like what we can contribute to a QLAC. It made some of the Roth contribution limits more favorable. So if you make over 150,000, now your employer starting next year will have to put your catch-up contributions into the Roth. And then there's some other more accessible features to the Roth. But no, I don't feel like there's been significant tax changes. You know, they delayed the RMD age. So instead of 70 and a half, it's now 72 or 75. But none of that changes the strategies. Like, it doesn't change the way you think about the planning or the various tax rules that you incorporate. Matter of fact, it just, in many cases, increases the window of time that you have to do planning. So before, let's say I was going to retire at 65 and my Social Security and RMD started at 70 and a half, right? So this 5-year window to maybe do Roth conversions. Well, now, you know, Social Security, no point in delaying past 70, but now RMDs might be 72 or 75. So I actually even have a longer window of time to do some of that planning. Yeah, but overall, no, I think it's actually very relevant material still and covers. It's really a life cycle course, so it has different phases that cover, you know, when you're starting out versus like about to retire versus I'm 10 years into retirement versus the tail end of retirement. What do your later years look like?
There are a lot of there are a lot of concepts that are timeless in terms of what you need to be looking out for and planning on and so forth. If one spouse has retired and the other will in a few months, is it too late to do planning? Can your firm still help?
No, it's not too late, and that's not uncommon. So it's not uncommon for us to have, you know, age differentials, or even if you're the same age, one spouse could be, you know, we've had people, one on disability and the other one still working, or, you know, one who either chose to retire early or was laid off early, and the other that plans on working for another 6 to 8 years. So it's never too late to do planning.
Mm-hmm. In my 401k account, I have highly appreciated company stock. What is the best way to transfer out of my company stock and avoid ordinary income tax rates? And can I keep my 401k account open with other investments?
Well, those are tough questions to answer on the fly. So most likely, you are eligible for something called net unrealized appreciation tax treatment, which means you may be able to transfer the stock out of your plan, and you're only taxed, ordinary income tax, on the basis of the stock. But then you hold the stock outside of the 401k plan, and everything else above the basis would be capital gains tax. So you can't get away from taxes altogether, but there may be a preferential way to do that. However, we don't see NUA cases maybe once or twice a year. Mm-hmm. So I may have to look up these rules, and we might have to follow up in the comments on the YouTube video. But I'm fairly sure that when you do NUA, your entire 401k plan has to get rolled over. And I remember the last case we did, we had to go into this because there's certain triggering events, and this person had already taken one distribution, and that actually disqualified them from doing an NUA that year. It's like we had to wait till the next triggering event, which I believe for them was like 59 and a half, or I can't remember the specifics, but there are certain triggering times where you can do an NUA distribution, and I am pretty darn sure that you have to distribute the whole plan to, so, you know, your stock would get transferred out to a brokerage firm, and the rest of the assets in your 401k plan would roll over to an IRA, is how that would work.
We have a few more questions. Dana, how has the Paycheck and Paycheck, Tom Hegna, concept of guaranteed income for paychecks and portfolio returns, how has the Paycheck and Paycheck concept of guaranteed income for paychecks and then portfolio returns for paychecks, though not consistent income, but analogous to salary and bonus during working years?
Yeah, so I've never heard that term paycheck before.
I'm going to start using it.
I like that. It's a great term. So Paycheck, interesting. But I have heard it referred to as, guaranteed income to cover your fixed or essential expenses, and then, portfolio returns to cover the discretionary expenses. I think that strategy is just fine. We find that most of the people we're working with, they really want to solve for a lifestyle. They don't want it to be, well, this is my essential and this is discretionary. Mm-hmm. And so we have the ability to break that out in our planning model, but we just don't find that at least the people working with us, that's really what they're looking for. What they're really looking for is saying, look, here's my take-home pay now, and can I transition into retirement and have the exact same take-home pay, or even a little more in some cases, right? So we're solving for that. While I like the design and the strategy to always test worst case, right? I want something that stands up under a worst case scenario, but most likely we're not going to get worst case. So I don't necessarily want, for me personally, I don't want my paycheck in retirement to be based off as if worst case is happening right now. And so our typical approach is to say, well, here is a perfectly sustainable cash flow that meets all of the stress tests. So let's start there. And if we get some Armageddon scenario or, Great Recession or something, well, then we can make adjustments. And those adjustments are often small adjustments, like let's forego your inflation raise this year, that bring that portfolio back on track. So that's typically the way that we like to approach things, rather than saying discretionary versus essential. But I think that's a perfectly good way of looking at it too. I think that can be very effective for people who want that line really clear.
Dana said in the last webinar that she uses 3% inflation for all expenses except 5% for healthcare. What kind of return projections does she use for stocks and bonds? I heard 2% for Social Security growth. In addition, when she said 5% return on the portfolio in her presentation, did she mean real return? And what's the asset allocation of that presented portfolio? It's a lot of questions in there, sorry.
There's a lot of questions.
Yeah.
So yes, we typically use 3% inflation on living expenses, 5% inflation rate on healthcare related expenses. We use 2% as our inflation rate on most Social Security. If someone has a pension that has a COLA, we actually look up what that is and use it. We use 5%, and you asked, returns in our initial testing model on the portfolio returns, but then we test that over a Monte Carlo simulation and something called a historical audit. So we are testing that over various time periods in history that could be worse than 5%. That's the way to think of that. Are they real returns? Well, no. I mean, if we're inflating expenses at 2 and the portfolio is averaging 5, right? Well, inflating expenses at 3, it's a real return of 2. We break them out separately because the income that you're taking from your portfolio is usually only part of the income stream, right? You need some cash flow from Social Security. You might have cash flow coming from lots of different sources to cover expenses. So we're inflating all the expenses at 3%. We're assuming the portfolio averages 5%. So essentially, that's a real return of 2% over inflation, if that makes sense. So hopefully that answers the question.
So this is a little bit long, but I think I can break it out, Dana. I was looking at a SPIA immediate annuity. One using qualified money had a payout of 7.7. Another using non-qualified money had a payout of 7.6. Why does SPIA using qualified money have a higher payout than non-qualified? I would almost ask the company, because it doesn't seem like there would be a reason.
See, the only reason I can think of is there's some additional administrative costs maybe with qualified funds because of required minimum distributions or reporting. As a custodian, you have to report to the IRS. You have to get that form 5548, I believe it is. It's sent, So it might just be that they're pricing that in because of the additional, reporting requirements for qualified funds. I don't know, but you should ask them.
I'll follow up with the questioner. And then when looking at indexed annuities, the life income benefit rider payout percent is the same for qualified or non-qualified. With SPIAs, there's a difference with the payout. Why is that? I will follow up with that.
Yeah, that's
that
a really
individual.
interesting. So with index annuity, no difference in the payout, but with the SPIAs, you're seeing a difference in the payout.
Yeah,
Yeah, that's very interesting.
with the life
So
income
I
benefit rider. Yeah.
don't have an answer to that one. You've stumped me.
Yeah. You mentioned in past webinars that some people request a one-time retirement planning, and then the couple might come back in a few years and order another one-time review or planning. Do you keep the data for each plan for the future reference in case people call you again?
We do. Yeah, we do keep the data. So we have to keep data for, I believe it's 6 or 7 years. But yes, we do keep the data, through all of the required reporting period. And, most people would come back within that time frame where we would still have it.
Here are a couple of questions I'm going to put together. Do you do one-time plans versus AUM? And what type of clients is your firm accepting?
So we do one, yeah, everybody actually that hires us has to do I'll call it a plan. It's not one time, but it is a plan. And they may stop there. They may say, great, that laid out the logistics piece that we went over in the first part of this webinar, right? And they may have their own portfolio strategy that they want to go implement. And then a lot of the people, I think, over half that go through that planning process will say, yes, I then want you to also manage the assets. So we actually update the plan, the logistics piece, every single year. So for us, we wouldn't know how to invest someone's money without that logistics. Like, that is our map. We don't even understand how other firms kind of invest someone's portfolio without that kind of detailed roadmap. It's so important. We do it. We stress test the planning and update the tax projections and all of that every single year for our ongoing asset management clients. But everybody that comes in has to do a plan, and then from there they can decide, thank you, that gave me the logistics that I need, or they can, say, wow, I would really like you guys to take this over from here.
So a question on funding the bucket. In your example, you show funding the bucket in the 10 years before retirement. Where does this money come from? While still working, it is directing yearly retirement savings to after-tax bonds, CDs, instead of contributing to the 401k, or are you selling existing investments to get the funds? If the latter is the case, then doesn't have the opportunity, if the latter is the case, then doesn't that have an investment opportunity penalty? What if the person is relying on the contributions towards the end of work life to fully fund the retirement portfolio? Again, there's a lot in there.
Yeah, so here, what I tried to lay out is the equity allocation, right? I'm selling, so I'm contributing to my 401k plan while I'm working. And this $25,000 a year is going into equities. The reason I do that is, dollar cost averaging. Plus this money that's going into equities isn't going to be used till much later in retirement, most likely. Now, here, I know it sounds backwards, but I added $25,000 to equities, but through payroll, right? Every 2 weeks or twice a month, depending on how your payroll providers, right? That money's going in over the year, but I sold and went into the system and said, I'm going to take 60,000 out of my equity allocation and add it to, and if it's an IRA, you can buy an individual bond or a CD. If it's in a 401k plan and it has a stable value or a fixed account, you would be able to use that. For me, that's why I like having money in the IRA. Then I'm buying a CD for $60,000 that matures in 10 years. I'm not quite sure around why there would be a penalty. So usually within an IRA or 401k, like, you can change the investments around, any way you want within that account with no penalty.
It's possible. So one thing that people sometimes think about when we talk about bond ladders is that we're taking money out of some accounts and putting it into the separate ladder account. But actually what we're doing is we're building ladders within an IRA, if, for example, or within a non-retirement account or within a Roth if needed. So I'm thinking maybe it's the thought that you're taking money out of those accounts, and that might be where the penalty comes into play.
Yeah. Yep, that makes sense. And I forgot
yes.
there was a previous question, and I think she or he asked what the portfolio return was. So the actual year-by-year returns on this sample are here, and the allocation, equity to fixed income, and how it adjusts because of the market fluctuation and the changes is here. And so I believe this was designed to be an average return over the time period of somewhere between 4 and 5%. But you could run these numbers and use the average feature in Excel and see what it is. I just don't have that spreadsheet open to be able to tell you. It definitely was not over 5, though.
Yeah. Do you prefer TIPS or nominal bonds for building ladders?
We use nominal bonds because we've already built inflation into the cash flows. Like this example I have up here right now doesn't have inflation built in. I used a flat 60,000 just for the sake of illustrating a concept, but in reality, like we're personalizing this to exactly what someone needs, and there's already inflation baked into those cash flows. So we're using nominal bonds that mature in the amount needed, and we've got inflation already built into the amount we said we would need in the future.
How do you logistically account for income and expenses and taxes and the disposition or conversion of real estate used for income during early retirement years?
Well, with a lot of spreadsheets.
Yep.
We actually built a real estate kind of module for our planning tool because I had a friend who has, I think it's 16 properties. And so, I worked with her on it. I said to her, I said, look, I'm going to do your plan for free if you will help me build this module for us. And so she did. So it was a good trade-off. But it's challenging, right? Because we don't know the exact price of the property. We have to take into account, depreciation, recapture, capital gains, what your cost basis on the property is. A lot of properties are delivering tax losses along the way, but they can be cash flow positive. But we will actually project all of that out. I was just looking at a plan this morning, and this client, we have their portfolio cash flows coming out $6,400 a month for this year and next year. And then to supplement that, they have some stock options selling. But then in 2025, we have them projected to sell a rental property. And so what we have to do is build a contingency plan. Assuming that rental property actually is able to sell in 2025, that's where their cash flow will come from that year. That will meet their cash flow needs. But what if the real estate market's in a slump that year, right? So we have to have a backup plan that says, okay, well, if they can't sell that property that year, then here's where the cash flow is going to come from. We're going to have to take it out of the IRA. And then when eventually the property does sell, we'll have to, so there's a lot of moving parts. And so with those kinds of things, you can plan it all out, but you also really need to have a contingency plan because as we know, like there's no guarantee with a property that it's going to sell at that price at that year that you want to sell it.
Do your clients have to transfer their investments from their current investment company to Schwab if they hire your company to manage assets?
They do. So we can't right now manage assets elsewhere. We are looking at someday, we'll probably add Fidelity as an additional relationship that we'll work with. Right now, it's just at Schwab, so we just don't have any ability to do it if the money's not at Schwab.
Does your logistics plan, and we think of it as a juicing plan, but the logistics is a great way to think about it. Does your logistics plan include a plan for IRA conversions to Roth that minimizes taxes?
Absolutely. So we break our planning into 3 different meetings. We call them strategy meetings, but there's different topics we cover at each meeting. So strategy 1 is like, I think of it as stress testing. It's really big picture logistics outline. Like, does your plan work? Do you have enough? Strategy 2 is, okay, let's dig into the details of Social Security claiming and Roth conversions and what tax strategies have the potential of improving the outcome so that we can lay all that out. Now, there's been a lot of things in the last few years that changed. So in terms of the timing of the RMD. So we laid out, let's say, a Roth conversion strategy a few years ago, and then now we get to this year, we might say, well, all the tax rates indexed with inflation, and so we have a lot more room in this tax bracket than we thought we would. We can actually do a little bit more Roth conversion, and now your RMDs got delayed by 2 years, so I can do maybe more Roth conversions, not as much each year, but stretch it out over an additional 2 years. So I think of it as like we give you a roadmap for our ongoing clients. Then every year we actually do a tax projection to look at that particular year and say, well, we thought maybe we were going to do $90,000 of Roth conversions, but you realize $20,000 of capital gains. So really we should only do $70,000 of Roth conversion this year, or XYZ happens, we can do 110. Yes, we include all of that in the planning, and we tell people like it's not definitive. It gives you going in approximately the right direction. Here's the years where you want to look at this kind of opportunity.
There's an enormous educational component. So people who are doing a plan and then want to do it themselves for a while have a good sense of all of the variables that would potentially come into play. And very oftentimes that's when they'll say, it's more complicated than I thought. It's like, yes, it is.
Yes.
So for AUM, are investments unique to the client, or does your firm have various model portfolios that clients are directed into?
Well, each portfolio is built customized to that client, and it follows a model. And so let me explain the difference. So if I were putting a client's money, like I've spent time in my career at a major wirehouse brokerage firm, well, you put people in separate account managers. So I put $100,000 and it went into that portfolio strategy, which was the same strategy for all clients in that portfolio. We use portfolio models, which will say, okay, here's the asset classes that are designed to minimize the worst case outcome. But when your assets transfer in, those are bought in your account, depending on how much you have in your Roth IRA or this or that, or you might have taxable assets that we can't sell because of taxes. And so it has to be customized to each client. It doesn't go into a pool. It's not, we don't place trades that go across all client accounts. Everything is for that client. So hopefully that answers that.
Yeah, it's a very labor-intensive process for sure.
It is a very labor-intensive process. I wish there was software, but there's not. Retirement planning is a customized process, right? It's a customized, it is not a one-size-fits-all. This came up at the DC event that I was just at too, this discussion of they had invited about 3 or 4 advisors from around the country, and product providers, people, CEOs of financial institutions were there. And we were talking about just the time-intensive nature of retirement income planning. And that was a common theme that came up, is it is a lot more time-intensive than it is in the accumulation phase.
Is there a retirement savings minimum value for your clients?
So we don't have a minimum portfolio size. We do say, in general, we reserve the right to set a $12,500 minimum annual fee. That would equate to 1.25% on the first million of assets. We'll see in our language a lot. We find that that's the asset size where people probably feel very comfortable that the value they're getting for what they're paying. But we have clients under that, and we work with each individual that we can. We're back to a wait list again, and so everybody's kind of at capacity here right now, but we work with people that we can. So if you want to have a conversation with us, we can take a look, and we refer people out. So sometimes we've referred actually a lot of people out recently. So I have people like one planner that used to work here, one that Jason Branning's firm, Branning Wealth Management. So I have a whole list of people that if we think we're not a good fit, or you think we're not a good fit, then we will say, here's who we think you should talk to based on what you've said.
For your AUM, for your assets under management, what % is actively managed and what % is passive with index funds?
So it's essentially all passive funds. So whether it's dimensional funds, DFA, Schwab index funds, Vanguard index funds, Avanti, but primarily, our preference is dimensional funds. We're not biased. We don't make any more money from using one fund family than another, but it is all, and DFA will not, they technically don't call themselves an index fund, right? They've basically created their own criteria for how they dissect the market and then have said, here's how we define value. And so if they're building a fund that's weighted toward large cap value, it's not an actively managed fund, but it's not tracking a traditional index either. But it's what's called a passive strategy because they're not actively trading those stocks.
I think potentially a couple more here, Dana. One is, are you in favor of an inflation rider with a SPIA?
I'm not really. This just came up on Twitter. I said something and they wrote back, something about SPIA, and I'm like, are there any SPIAs out there that even offer inflation riders? And they said there's one somewhere where you can buy a set 2% increase. But no, because of the go, slow go, no go spending patterns that are observed, and if you maximize Social Security, that's going to have a strong inflation component in it. So you're delaying that till 70, that you would do that before you would ever buy a SPIA. And then, your SPIA could be not inflation indexed and you would get a little bit more now. So your Social Security would be the inflation adjusted piece. And then your SPIA would be, in inflation adjusted terms, I'm spending a little bit more in early retirement rather than in later retirement. Yeah.
Here's a question on the go, slow go, and no-go years. Do you use the go, slow go, no-go concept for spreadsheeting of expenses rather than constantly escalating expenses? My projection shows that my monthly expenses at 90 will be $40,000 a month, and I can't imagine what, as a 90-year-old, I'll be doing with $40,000 each month with a smiley face.
Well, yes, and so I don't know if you're saying that that you are a client of ours, and that's how we ran your plan. But
I don't think
yes,
so.
we do use the go, slow go, no go concept, and we work with each. So some clients want to see that they feel more comfortable seeing that ever escalating expenses. But our plans typically so there's a few different ways we do it. Sometimes we'll say, well, I'm going to assume a 3% inflation rate, through the first 10 years of retirement. And then I'm going to inflate your expenses at 2% from then on out, or 1%. Or sometimes we go down actually in the expenses and we'll say, okay, like in the example I used in the logistics piece, you're going to spend more on vacation in these first 10 years, and then that's going to taper off. So the reduction in spending is happening that way. But yes, we absolutely customize that to the client.
Do you guide the heirs of your clients to provide value in the transition at death?
So what we love is when we get to meet the heirs and not at death. And so, we've had clients bring in their kids, open accounts for their kids. I just had this wonderful meeting 2 weeks ago with I'll call it my inaugural client since I moved here to Arizona, that I've worked with since 2001. Have heard about their kids for 20 plus years, and so they invited them into a Zoom meeting. The husband has been diagnosed with mild cognitive decline, and so they wanted their kids to get involved. And so we all jumped on a Zoom meeting and went through the plan and, went through everything. So that's the ideal way to do it. And, we have found that if the first time we meet the kids is because of a death event, and especially if it's the second spouse, the kids don't know who we are, and so those assets, they may have other plans for them. They may transfer them, they may want to spend them, who knows what they're going to do. But if we can meet them ahead of time and they can see what the planning process looks like, then we are in a position to be able to help guide them better on what to do with it.
Finding, Dana, that there are a few more here and there instances where people want to clients want to get their adult, one or two of their adult kids involved in the planning process and seeing what's going on. And it's great that because of the way we work, we can be talking to, an adult child several states away. But more and more people want their kids to kind of know what's going on. And we certainly encourage that.
Yeah, I agree, Nancy. Absolutely.
I think we're at the end of the questions, if that's possible. And it may be possible. Nothing else is popping up here. There were a lot of. I think you answered all of them as you always do.
Great. Well, we will also try to post. I'm trying to go back once it gets posted to YouTube, and if I see additional questions in the comments, trying to get those answered or post links to things if it came up. So, as you know, I'm losing my voice. It takes about a week, and we edit these recordings. Susie, our office manager, takes out all of our ums or any technical difficulties, and then she posts them to YouTube and sends an email out. So thank you, everybody. This has been wonderful. We appreciate your time.
Yep. Good night, Dana.
Bye, everybody.